In today's video, I am going to uncover a secret to making money in the stock market that few people talk about. But before I get going, if you could do me a favor and hit that most amazing and wonderful like button. Also, if you have not done so before, consider subscribing and turning on those bell notifications so that you never miss a video. If you are interested in my personal stock callouts, then consider subscribing to my Patreon. I have a link in the description down below. It is no secret that behind every successful investment manager or individual investor, there is a written, measurable, and repeatable investment strategy. However, many investors jump from one trade to another, putting little effort into creating and measuring their overall strategies. The following rules will help you create a sustainable investment strategy. Ideally, this will lead to a more consistent performance and help mitigate emotional investment decisions. Most importantly, it will help avoid a scattered portfolio of individual investments that, when looked at as a whole, have no overall theme or objective. Below are 4 steps to creating an investment strategy. Number 1, write it down. The first process is to write down your investment strategy as a process. To quote the late Dr. W. Edwards Deming, a world-famous author and management quality consultant, if you can't describe what you are doing as a process, you don't know what you are doing. Like anything that requires a disciplined process, it is important to write down your investment strategy. Doing this will help you articulate it. I personally have a playbook. This is a journal that I use each and every day. Once your strategy is written, you should look over it to make sure that it matches your long-term investment objectives. Writing down your strategy gives you something to revert back to in times of chaos, which will help you avoid making emotional investment decisions. I have reasons for entry and exit on any position that follows a strategy. I never take a position in a company without it matching up. Number 2, have beliefs. You should have beliefs about why investments become over or undervalued and how to exploit them. This includes whether or not you believe that investment markets are efficient. Ask yourself, what makes me smarter than the market? What is my competitive advantage? You may have special industry knowledge or subscribe to special research that few other investors have. Or you may have beliefs about exploiting certain market anomalies, like buying stocks with low price to book ratios. Once you have decided what your competitive advantage is, you must decide how you can profitably execute a long-term trading plan to exploit it. Your trading plan should include rules for both buying and selling investments. Also, keep in mind that your competitive advantage can eventually lose its profitability simply by other investors implementing this same strategy. On the other hand, you may believe that investment markets are completely efficient, meaning that no investor has a consistent competitive advantage. In this case, it is best to focus your strategy on minimizing taxes and transaction costs by investing passively in indexes. Number 3, make it resilient. A major key to any good investment strategy is that it will perform well in every market environment. Good investment managers know where their investment performance comes from and can explain their strategy's strengths and weaknesses. As market trends and economic cycles change, many great investment strategies will have periods of great performance, followed by periods of lagging performance. Having a good understanding of your strategy's weaknesses is crucial to maintaining your confidence and investing with conviction, even if your strategy is temporarily out of sync. It can also help you find strategies that may complement your own. A popular example of this would be mixing both value and growth investing strategies. Number 4, measure it. It's difficult to improve or fully understand something that you do not measure. So you should have a benchmark to measure the effectiveness of your investment strategy. Your benchmark should match your investment objective, which in turn should match your investment strategy. I write down every result by strategy and have a weekly report card of my exits. 2 common types of investment benchmarks are relative and absolute benchmarks. Although it can be a time-consuming process, it is important to consider the amount of risk you are taking relative to your investment benchmark. You can do this by recording the volatility of your portfolio's returns and comparing it to the volatility of your benchmark's returns over periods of time. The bottom line is that any good investor has a clear understanding of why investments are overvalued or undervalued and know what drives their investment performance. A well-thought-out investment strategy can help consistently generate long-term results. And that's all I have for you today, and Raytoven out.